What's up, everybody? I'm sure everyone is familiar with the stock that we're going to talk about today. It's, of course, PayPal. They just released earnings before the market opened here. The stock is currently down about 18%, and even before this, they were essentially right at a 52-week low. We're at prices we haven't seen since 2017. From the peak, it's down 85%, but even in just the past year, this stock is down 50%. So this is what we're going to talk about today. We're going to go through their earnings report. We're going to try to decide if the sell-off is justified, what happened here, and we'll see what risk reward looks like for PayPal stock today. If you get value out of the video, subscribe to the channel. If you want to support what I do, join the Discord, grab my Google Sheets template here, anything like that, consider following me on Patreon. Link to that will be down below. Now let's get into PayPal. And before we go into the report, you should know I own PayPal stock. I've held this stock for over 2 years now. I was buying in the 50s at the end of 2023. At one point at the beginning of 2025, when the stock hit $90 a share, I was up about 70-ish% on this position. And of course, I've given all that back. I didn't sell at the top. Instead, I've held on. And in fact, recently, I've been adding to my position. My cost basis is about $56 a share, so obviously I'm down on this. Of course, nothing here is advice to buy or sell PayPal stock. I just give you my opinion and I tell you what I'm doing with my money. And at the end of this video, I'll tell you what I'm thinking about with my PayPal position. Now let's get into the report. And there's two pieces here that I think the market is reacting to. First, there's just the actual numbers from the fourth quarter. And here, the numbers weren't bad. They were a little bit on the low side for what the market was expecting. Total payment volume up 6% on a constant currency basis. Revenue and transaction margin up 3%. Earnings per share up 3%. Those numbers are a bit on the low side, though really not by much. I mean, revenue was off maybe 1% to 2% from estimates of maybe about $8.8 billion. Transaction margin not keeping up with total payment volume suggests that the take rate across their revenue mix here is decreasing. Active accounts, pretty flat. I mean, up a little bit. And they say this is mostly from Venmo. Venmo we'll look at. That's a one bright spot here. Payment transactions for the quarter up 2%. But if you exclude unbranded, which is lower margin, that's where they're just operating as a payment service provider. You don't see the PayPal button. They don't make as much money from these transactions. So when you exclude those, they're up 6%. So that's close to in line with what we were expecting. And all in all, I think that kind of sums up this quarter, close to in line, a bit on the bottom end of what people were expecting. Not disastrous, really. They're still very profitable, $1.5 billion in operating income. They returned $1.5 billion via share repurchases. So they've been consistently buying back stock here. Obviously, we'd love to see transaction margin growth of 6% instead of 3 to 4%, but this isn't really the reason for the huge sell-off. Now we get to the guidance. And this is certainly going to catch investors by surprise, certainly surprised me. For full fiscal year 2026 guidance, they're assuming transaction margin will decline. They're saying earnings per share is going to be down as well. This is all in spite of the fact that they're saying adjusted free cash flow of at least $6 billion, which, kind of similar to this year. And they're going to continue with share repurchases of about $6 billion. So continuing to return a ton of capital to shareholders, but guiding for a decline in transaction margin and earnings per share, I don't think that's something the market saw coming. And honestly, even listening to the call, it's hard for me to fully understand how they're coming up with that guidance. On the call, they said that the branded outlook for 2026 would be slightly positive to low single digits. And when you look at January quarter to date, while the environment continues to be dynamic, quarter to date, we're running slightly better than we were in the fourth quarter. So while we'd love to have more growth here, it's not like they're saying that branded is contracting. And there's some areas to be excited as well. Venmo has continued to perform strongly. Monthly active accounts here up 7%, revenue up 20% year over year. So that was a bright spot, but there was very little talk on this call about other growth drivers in the future. There was almost no discussion of ads. Agentic, they mentioned a little bit their deal with Symbio, but they also said Agentic won't materially impact 2026 growth. Just looking over total payment volume divided up by segments here, Venmo stands out, 13% growth. The number that I'm sure has everyone worried is 1% growth for branded checkout. Again, that's a very high margin part of the business, so seeing that only grow 1%, not great. They said the 4-point deceleration from the 5% that they were seeing in the third quarter was more than we expected and was concentrated in three main areas. First, US retail weakness. So they're saying that people aren't spending as much, particularly lower and middle income consumers. Second, they highlighted international headwinds, particularly in Germany. Germany is a big market from them, and now they're talking about competition from alternative payment methods. And third, they highlighted deceleration in several high growth verticals: travel, ticketing, crypto, gaming. These were things that were growing well in the fourth quarter of 24, the quarter we're comparing this one to, and now that's pulled back a bit. Whichever way you slice it, growth is low. It's not a good report, but still guiding for declining earnings per share. I still don't actually see, after going through this and listening to the earnings call, how they came up with that guidance. Of course, there's one piece of the story we haven't talked about yet, and that is that Alex Chriss is out. Enrique Lores, who's current CEO of HP and also is the current chairman of the board for PayPal, he is stepping in to replace Alex Chriss. That's definitely another surprise, and for a lot of investors does not bode well. But something we've talked about before, and something we see a lot actually when a new CEO comes in, is that they really just want to reset the guidance. Reset expectations. A lot of times they'll give lowball numbers so that then they can outperform the low numbers that they set. One analyst even asked, is it fair that Enrique was involved in the process of sort of setting the expectations? And they said, with respect to Enrique's involvement from a strategy perspective, look, he's deeply involved. He's helped shape and reviewed not only the capital allocation strategy, the investment priorities that can support them, but also the 2026 guidance. So even though he's not CEO yet, I read that as Enrique Lores has basically set this guidance here. Who knows what's going to happen going forward, but again, new CEOs like to set low expectations and then outperform. Now, I think it's time we go to our spreadsheet and see what we can expect for a return on our investment in PayPal stock today. Obviously, there's bad news, and looking at a chart like this doesn't feel good. But we should keep in mind that this company is currently trading for about $40 billion, and they are still guiding for about $6 billion in free cash flow. Let's not forget that this is still an extremely profitable company. Now, the way I look at free cash flow, I net out their share-based compensation. So I would think of this more like $5-ish billion in free cash flow. But even still, the company is trading for 8 times free cash flow, a double-digit free cash flow yield. You really don't need any growth here for this to probably be a decent investment. So let's get into our sheet. The numbers I have here, I have not changed yet. These are the numbers I had in place last time we looked at PayPal stock. This is after their third quarter earnings. And even if they're lowballing the guidance here, the numbers I have in place, they're too optimistic. I do need to bring these down. Let's start with my base case. I was assuming 6% growth on the top line every year for 5 years. I'm going to drop all my growth numbers down here quite a bit. I'm going to give them just 2% revenue growth on the top line for 5 years in my base case. This is likely underperforming inflation. So on a real basis, we're assuming contraction. Operating margin, I'm going to pull this back as well. We haven't seen the margin really drop off yet, but payments is a competitive space. I'm going to pull that back. 14% free cash flow margin. I actually think this is pretty fair. I mean, we're assuming $4.5 billion to $5 billion in adjusted free cash flow. And again, for me, adjusted free cash flow always means free cash flow minus share-based compensation, because that's a real expense when we buy equity in a business. So my assumptions here are below their guidance. And as far as a multiple, I was previously giving them a 14 times multiple. For a highly profitable asset-light company with a strong balance sheet, I actually thought that was reasonable, but given the slowing growth, I'm going to pull this back quite a bit. I'm only going to give them a 10 times multiple. And I think I'm being conservative here, but you let me know down in the comments. Maybe I'm still not being conservative enough in my base case, but if these assumptions come true, I'm looking at a 19% annualized return on this stock every year for 5 years. As far as the bear case, I'm going to bring revenue growth negative. We're going to change this to negative 3%. This is assuming 5 years out from now, revenue is down to $28 billion. I'm going to pull their operating margins back to 15%. I'm assuming the free cash flow is going to drop from about 3.8 billion all the way down to 3.4 billion. And as far as the multiple, I'm only going to give this company a 7 times multiple. And yes, that might sound ridiculous, but I really can't assume multiple expansion in my bear case. And as far as a multiple of enterprise value to operating income, they're trading for close to a 7 times multiple actually now. And with negative revenue growth, contracting margins, trading for a 7 times multiple, you're still looking at 3% annualized return on this stock in this case. Obviously, that'd be poor performance, but even with these assumptions, you're not down on your money after 5 years. Now, in my bull case, clearly 9% growth on the top line was way too optimistic. I'm going to assume 3% growth expanding to 5% growth in the future. I'm going to assume that they can maintain their margins where they are now. And as far as a multiple, I was giving them a multiple of 20. I'm going to pull that back to 16. This might seem like a long shot today, but I do think this is completely believable in a bull case. Again, sentiment can change very quickly on stocks. Think about the sentiment behind Google a couple years ago versus today, Meta back in 2022 versus just a couple years after that. I'm not suggesting that PayPal is as strong a business as those companies. I'm just suggesting that merely turning around to a 16 times multiple is really not crazy. And if the assumptions in this scenario come true, you're looking at an over 30% annualized return every year for 5 years. That would be more than a 4x on your money in this time. So overall, what are my thoughts here? It was not a good report. Let's start with that. PayPal is a stagnant business. I think a lot of people have given up. They're selling. This is basically just capitulation that we're looking at here. But frankly, I look at this and I just think it's too cheap. I own the company, so that may be biasing my opinion here. But as far as what I'm doing with my money, I'm certainly not selling today. I continue to think risk reward actually looks very good. And as scary as it is to buy when the price is down so much, all things equal, a lower price often will offer better risk reward. Now, I'm not saying all things are equal. I feel like I was optimistic in my assumptions. They needed to be pulled back. But still, I think it's too cheap. Now, am I going to buy more at these prices? Maybe. I haven't decided. This is about a 4% position for me, so I might increase that. If you do own PayPal stock and you're trying to decide, should I sell? Should I hold on? Should I add more? Again, not advice on what to do, but just as a framework for making that decision, just realize that markets are very volatile. Individual stocks are extremely volatile. Price often moves much more than the underlying value of the business. Is PayPal worth less than half of what it was a year ago? Try to decide what you think the business is worth and, maybe a base case, bear case, bull case, whatever it is. You need to have your opinion about what the risk reward looks like. And you should make your decision to buy, sell, or hold PayPal stock based on your thoughts on risk reward, not based on fear or greed or an emotional reaction to a dramatic move in price. And I think with that, we'll end it here today. If you got value out of the video, subscribe to the channel. If you want to join the Discord or grab my template here, consider following me on Patreon. Link to that will be down below. If you agree or disagree with anything I said in this video, leave that down in the comments. I'd love to hear from you guys, and I hope to see you all in another video.